Welcome to the deep dive. Ever wondered how smart business decisions actually get made?
Mm,
Often it really boils down to this powerful tool, marginal analysis.
right.
Think of it as like your shortcut. Helps you get clear when you're facing choices, new products, production levels.
Or even deciding if a part of the business is really, pulling its weight.
Exactly. So today we're not getting bogged down in the huge picture. We're focusing laser focus on what really changes when you make a specific decision.
Yeah, that's the key. This deep dive, it's really about giving you a framework for spotting which costs, which revenues are actually relevant when you're weighing options.
Okay.
And this isn't just theory, it's practical. It hits the bottom line. Launching something new, deciding how many to make,
Uh-huh.
maybe a special order comes in,
Right.
or you're wrestling with make versus buy.
Right. Or even looking at whole chunks of the
But
company.
in those scenarios,
Uh,
marginal analysis helps.
okay, so when we're looking at these choices, the first big hurdle seems to be figuring out which numbers even count, right? It's easy to just look at everything.
That's a really key point. You've got to separate relevant costs from irrelevant ones.
Okay.
Relevant costs, they're the ones that will actually change depending on what you decide.
Ah,
And it's important to get this. Both variable costs, the ones that change with volume, and sometimes even fixed costs can be relevant. Depends on the situation.
and irrelevant costs just stay the same no matter what.
Exactly. They don't move with the decision.
Like sunk costs, right? That money we already spent.
Precisely. Sunk costs are the classic irrelevant cost. Historical. Can't get them back.
So that old machine we bought.
Yeah. The electromag example is perfect. What they paid for the old machine, gone. It's totally irrelevant to deciding whether to buy a new, maybe more efficient one.
Focus on the future then.
Always. Future costs, future benefits. That's the game.
Okay, got it. So beyond the sunk costs, what are the main types of relevant costs we should be looking for?
We'll think about direct costs first. You can easily trace those to a specific product or service, usually relevant.
Okay, like materials for that product.
Exactly. And prime costs, direct materials, direct labor, generally relevant too.
Makes sense.
Then you have discretionary costs, things management decides on periodically, like maybe landscaping or a specific ad campaign, usually relevant because it's an active choice.
Right, they choose to spend it or not.
Incremental costs are super important. These are the extra costs you take on if you produce more.
Always relevant.
Always. Includes variable cost and any fixed costs you avoid if you don't do the extra production.
And opportunity cost. I hear that one a lot.
Vital. It's the value of the next best thing you give up.
Like using factory space for product A means you can't use it for product B.
That's a perfect example.
Yeah.
The profit you lose from product B is an opportunity cost of choosing A. And finally, avoidable costs and revenues. If a cost disappears or revenue is lost based on your choice, it's relevant. Always.
Okay, let's make this concrete. Special orders. Someone wants a one-off batch, maybe at a lower price. How do we analyze that?
Okay, the core idea is simple. Compare the special price to your relevant costs. But there's a big if.
Which is?
Do you have spare capacity? If you do, like the cater company example, you only need to cover your incremental costs.
The extra costs just for that order.
Right. If their incremental cost was, say, $50 per unit, any price above $50 adds to profit. Simple.
But what if we're running flat out, no spare capacity?
Then it gets trickier. You must include opportunity costs.
Because taking the special order means...
Means you might have to bump a regular, maybe more profitable order. That lost profit, it's a cost of taking the special deal.
So in the caber case, if they lost $10,000 profit from another product...
That effectively raises the cost of each unit in the special order. The minimum price they'd accept goes up, maybe to $60 in their example.
Nice. Okay, next classic.
Yeah.
Make or buy. Build a part ourselves or just purchase it.
Yeah, common one. Here, you compare the relevant cost of making it internally versus the supplier's price. Lowest cost wins.
Seems straightforward, but what's the catch?
Relevant costs. Remember offset manufacturing. Maybe their total internal cost looks higher than buying. But if making it uses, say, a supervisor whose salary you'd still pay even if you bought the part, that salary isn't relevant to the make side.
But if you could, say, eliminate that supervisor role if you buy the part.
Then that supervisor's salary becomes an avoidable cost. It's relevant. It counts as a saving if you decide to buy. You compare the purchase price to only the internal costs you'd actually avoid.
Okay. What about processing further? We've made something, but could we tweak it, process it more, sell it for a higher price?
Right, the sell or process further decision. Here, you focus only on what happens after the initial production point, the split-off point.
So ignore costs already spent.
Exactly. Those are sunk. You compare the additional processing costs to the additional revenue you'd get.
Like the Jackson Ink
Yeah,
soap example.
perfect. For their lavender soap, the extra cost to make it fancier wasn't worth the small price bump. Incremental cost was higher than incremental revenue.
But the rose soap.
The extra revenue did outweigh the extra processing cost. So processing the rose soap made sense. The key is ignoring those shared joint costs from before the decision point.
Makes sense. Okay, last one. The tough one. Keeping or dropping a whole product line or business segment.
Yeah, these are big decisions. You need to compare the contribution margin you'd lose from dropping it.
The profit it was generating before fixed costs.
Right. Compare that lost contribution margin to the fixed costs you can actually avoid by dropping the segment.
So it depends if the fixed costs go away or not.
Hugely. Look at Chowderhead Industries. First scenario. Their conch chowder looks unprofitable, but its fixed costs are unavoidable. Maybe shared factory overhead.
So dropping it doesn't save those costs.
Correct. And if the chowder is still contributing something, anything, towards covering those unavoidable fixed costs, you're actually better off keeping it, even if it shows a loss overall.
But if dropping it does let them avoid some fixed costs, like maybe a dedicated manager or equipment.
Then it's different. If those avoidable fixed costs are more than the contribution margin they're losing, then dropping the segment actually increases the company's overall profit.
So it all comes back to what changes.
That's the absolute core of marginal analysis. Focus on the change. What costs change, what revenues change because of this specific decision.
Not the whole picture, just the delta.
Exactly. Understand relevant costs, opportunity costs, factor in your capacity. Doing that lets you make much sharper, much more profitable choices in all sorts of situations.
It's a really powerful way to cut through complexity. So for you listening, maybe think about this beyond just business. When you're making personal decisions, weighing options, what are the real costs and benefits that actually hinge on your choice? And maybe more pointedly, are there any sunk costs in your own thinking? Things from the past influencing you now, even when maybe they shouldn't?
Good food for thought.
Definitely something to mull over. Thanks for diving deep with us today.